Hey, welcome to the Mortgage Minute for July 23rd. Obviously, the big news this month was the Bank of Canada cutting interest rates. I'm going to go back to July 1st, though. The headlines were all leading up to this, and there's lots of talk about, first of all, July 1st, economies dip stokes recession fears. A lot of them, they're using the R word again and talking about potential recession. I would actually encourage, if you want to have some fun, go to the July 1st report on business. They put together this fun game of snakes and ladders, so you can have fun with the economy. It's called the Economic Snakes and Ladders, and just some fun, something to do there. Going back to headlines later that week, a stubborn trade deficit points to a rate cut. So there was a lot of talk about potential rate cuts leading up to the Bank of Canada's decision, including the IMF cutting the Canadian outlook. So clearly, and here they say the country's prospects have buckled under the weight of a first-half slowdown and lingering oil shock. So the impact of the drop in oil prices has obviously had an effect on the Canadian economy, and not necessarily a good one. So all this combined with some international, of course we talked about Greece last time we had the Mortgage Minute, and this week the topic is China. The Chinese stock markets, by the way, shows that the first 6 months of 2015 they jumped up 47%. Everybody's all excited how much money they made. Well, by Wednesday's close, virtually all those gains have been lost. Speaks to the volatility of international stock markets, etc. So, at the end of the day, the Bank of Canada takes a step back, and when they come up with their rate announcement, not a huge surprise. In fact, Stephen Pullis said the facts have changed quite quickly, actually, in the last 2 to 3 months. So, there's an old Chinese proverb that says, "May you live in interesting times." I get the feeling we're there. There's lots that you can talk about why they were doing it. And here Stephen Pullis says, "No doubt we have worked our way through a mild contraction." Interesting that Pullis was very careful to avoid the word recession. Now, but here's the one thing that's really important. Number one, obviously, the move by the Bank of Canada to cut rates a second time in 2015 by a combined half a point is designed to stimulate the economy. So it begs the question, if that is the purpose, wouldn't it make sense for them to put pressure on the banks to match the rate cuts? In fact, their banks made a move, and here we say banks moved to lower rates. I'm shocked that headlines didn't say the truth. They moved to lower rates, but they didn't match the rate cut. The bank cut rates by a quarter point, and the banks only matched it by, the Bank of Canada dropped by a quarter point, and over the course of 6 months, it was a combined half a point. The banks combined have only dropped rates by 0.3. So they haven't even matched what the Bank of Canada's done. So if the Bank of Canada's reason for doing this was to stimulate the economy, what good does it do if the banks don't support that and pass that savings on directly onto the consumer? Instead, the banks are banking, no pun intended, they're banking that profit between half a point and 0.3%. That spread is going right into the bank's profit margins. So, and of course, we all know that they need that, right? More than the consumers do. Cynicism aside, my colleague Callum Ross did a great interview on CBC Radio, basically suggesting all Canadians should be outraged, and there should be more governmental outcry as to why the banks are not passing on this discount. And it begs the question, why isn't the government stepping in and saying, well, wait a second, if we lower the prime rate or lower the Bank of Canada rate for the purpose of stimulating the economy, and you charter banks are not matching this, you're basically discounting the benefit that we're intended to do. And how is this helping us with our objective, which is supporting and stimulating the economy? So I dug a little deeper on that. By the way, another colleague of mine, Dustin Woodhouse, had a great comment. If it went the other way, do you think the banks would have been that slow to match? I think not. If the rates had gone up, the Bank of Canada raises rates, banks will be right on top of that, raising rates right away. So it begs the question, why isn't the government getting involved and putting pressure? Why isn't there more pressure on the charter banks to match that rate cut? And I dug a little deeper, and there was a great article here by David Rosenberg, Why the Bank of Canada Cut Rates Now. And really, at the end of it, it wasn't about interest rates and the consumer and the housing market, because the housing market and the automotive market are doing fine. It's the export market. So really, who was the great benefactor of this rate cut? It was the drop in the loonie. The Canadian dollar took a virtual free fall, and that's great for the export sector. What needs help is the export sector, and this is an area that receives support from the currency via the interest rate channel. So with that in mind, the Bank of Canada may have cut interest rates by 25 basis points, but using old monetary conditions, today's move in the currency is equivalent to a full half a point easing for the beleaguered export sector. So, in summary, the real reason the Bank of Canada is making this move is to support the export sector, and to do that, a lower Canadian dollar is beneficial to the export sector. It's terrible if you're going shopping in the States this weekend, but it's great if you're exporting product to the States. So that's the real reason behind the Bank of Canada rate cuts. What does this mean to you? It means you do, even though the banks haven't matched the 25 basis point cut, they did match it. They did drop prime by 15 basis points. That means if you got a prime minus 70 or 75 mortgage today, that puts your interest rate below 2%. So if you have an interest rate right now over 3%, it's worth analyzing, looking at the pros and cons of breaking that mortgage and getting a new one. Today more than ever before, it's worth booking a consultation. And by the way, if you're looking at your pension, your retirement, if you're getting close to analyzing those numbers, interest rate cuts actually impact your pension returns in whether it's the stock market or whatever you're investing in. So it's a great time to analyze that. We can do both. Go to peterkinch.com and book your free consultation, because it may be financially worth it. So that's the Mortgage Minute for this week, and we'll talk to you guys soon. Thanks. Bye for now.